Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Andrew Ford, who's the National Retail Manager at Heartland Bank. Welcome in, Andrew. Good to see you.
Thanks, Gareth. Good to be here.
Andrew's here to talk about reverse mortgages, which is a product that Heartland is one of the few banks actually currently offering, and they get a bit of a bad rap, so we thought we'd just have a bit of a chat around the pros and cons. So before we get underway, we'll just sort of define what we're talking about for anyone who doesn't know. So a reverse mortgage is a mortgage that lets someone generally aged 65 or over borrow against the equity in their home and use the cash for whatever purpose they choose. And the loan isn't repaid until the borrower's property is sold. So that's pretty accurate in terms of what you guys are offering?
Yeah, it's really similar to a regular mortgage, but it's been designed specifically for seniors to have no regular repayments. So seniors can typically use it to access some of the equity or cash that they have tied up in their home to do the things that they want to do in retirement and enjoy that financial freedom and independence of being able to stay in their own home.
Okay, so I was going to say, give us your sales pitch. You've done a little bit of it there, but let's go, I guess, in a bit more detail. In your view, in Heartland's view, who should take out a reverse mortgage, why, and what are the benefits, the key benefits?
Yeah, well, look, a reverse mortgage can enable people who want to stay in their own home. So I guess that's the first criteria. You've got to own your own home. And I guess there's a big group of people out there that own their own home, but it's the biggest portion of their wealth. So they've got a potentially quite a valuable asset there, want to stay there, but want to access some of the cash that's tied up in it to enable them to do things in retirement. And that can be to renovate the property, to upgrade a motor vehicle, to travel is a really common one, either to see friends and family overseas or do that kind of trip of a lifetime. Or just to take some of that stress out of day-to-day bills, which when you're on a superannuation, it's often enough to cover the bare essentials, but doesn't stretch to the kind of one-off expenses or increasing costs such as rates and insurance.
Now, the interest rates on them tend to be variable or floating rates, and they tend to be considerably higher than, I guess, a standard floating than a floating mortgage rate on a standard mortgage, not a reverse equity mortgage. I'm just curious, I guess, why are they always variable, and also why are they? I mean, generally these loans have low loan to value ratios, so why are the interest rates so much higher than on a standard mortgage? Yeah,
so in terms of the fact that it's a variable interest rate, we think with this demographic, which is retirees and seniors, that it's much more important to have the flexibility of a floating rate than the certainty of fixed rate. So you've got to remember there are no repayments on this loan, so it doesn't impact the customer at all from a cash flow perspective. But with our product, it gives them the complete flexibility to repay it at any time if they choose to. So we think that flexibility is more important than certainty. In terms of the premium over standard variable rates, Heartland's rate is approximately 1.5 to 1.6% over standard variable rates. Now, there's a few reasons for that. First of all, as I mentioned, there's no repayments. So from our perspective, we get no cash flow from the loan. We've also got a number of things built into the product to ensure that it is really socially responsible. And that includes we guarantee the fact that the customer can never owe us more than the house is worth. So we take that risk. We also guarantee lifetime occupancy. So with a reverse mortgage, there is no term. So we guarantee the customer can stay there for as long as they like, and that they never have to make us a payment. So because of those guarantees, it effectively means that we take more risk than a standard variable rate, a standard residential mortgage, where there's typically people earning income and different ways of repaying. So hence why there's a premium, it's at kind of that 1.5 to 2% above the variable rates.
Now, in terms of the interest, obviously people pay that at the end. So I guess, when the property's sold, for whatever reason that might be, that's when they get the one big bill rather than paying regular interest, as you mentioned. I guess, in terms of that there's a bit of a danger there, or certainly people see potential for a bit of a danger there, that you get this huge whacking great bill at the end, and possibly it could be the children who inherit it.
Well, you're quite right that the loan is repaid off when our customers leave the home, and that's most likely through downsizing or moving into a retirement village. 75% of our loans are repaid through voluntary, and it's also for moving into care or death. In terms of leaving a large bill for the estate or next generation, as I said, we guarantee that they can't owe us more than the house is worth. So the estate is protected from that sense. We also offer all our customers an equity protection option, which enables them to protect a portion of the equity if they choose to. But what we're really careful about is to make sure that our application process is really thorough. So we take them through a process that shows them what will happen to the loan over time under a couple of different scenarios. And also every one of our customers has to take independent legal advice, and that is mandatory. So they're getting that independent advice to make sure that they understand it and that they're considering understand the product really well.
And when they do pay their interest at the end when the property's sold, there's compounding interest, is that correct?
Yeah, the interest compounds monthly.
Okay. And in terms of how much equity someone can take out of their property, is there an upper limit?
In terms of how much we will lend against them?
Yes.
Yeah, so yes, there is, and it's really based on their property value and their age. So we're quite conservative and prudent with Heartland's approach to this product. So for, say, a 70-year-old, and our average client's about 72, 73 when they take out a loan, we will lend up to 25% of their property value for a 70-year-old. But the amounts borrowed tend to be a lot less than that, and our average is around about that 10% level. Because what you find with this product is the amount borrowed is often a fairly modest sum, average about $45,000. But what it enables for our customers to do can be quite transformational in terms of doing those repairs and maintenance on their home, renovating it, or some of the really neat stories we hear about people doing the trip of a lifetime, and we've got some of the postcards and letters to prove it. Really, it can truly change lives.
Now, obviously, we're in an environment, especially here in Auckland, where house prices are rising very strongly at the moment. But I guess if I was to take out a reverse mortgage for 20 years or so, who knows, I guess, where house prices could be in 20 years and where they might go between now and then. So I guess what happens if house prices fall?
Yeah, well, you're a bit young, Gareth, but in terms of house price movements, well, look, first of all, as I said, we protect the customer. So we guarantee that they'll never owe us more than the house is worth. So they're protected from that, and they can also take out our equity protection option and protect a portion of their equity. But if house prices fall, it's the same as if you own your house with no mortgage or with a standard residential mortgage. Your equity will diminish based on what house price moves do. So we make sure that during our fulfilment process that customers aren't assuming current Auckland prices continue on forever, and neither do we in terms of our modelling. And so they're looking at a realistic picture over an extended period, because you talk about a 20-year term, that can happen, and it does happen. But typically we find that the median term is about 8 or 9 years. So customers are often using it for a transition. So they want to stay in their home because it connects them with their local community while they're still active. They've got grandkids that like coming around. They can do the grounds and stuff, but just want to have a little bit extra cash. And then they plan to move on to a retirement village or move in with friends and family or downsize.
What constitutes a default on a reverse mortgage?
Because there's no payments, there's no payment default side of things. So in terms of default, really it would have to be something similar to any other contract around if there was any fraud involved. In terms of a property, if there was something that was done to it that could materially diminish the value, if they were to make structural changes that could diminish the value, or without consents and so forth. So we have that type of protection in there for us, that the asset's going to maintain its value.
And can someone who's already got a mortgage take out a reverse mortgage, and can security on a loan be transferred? So, say there are two people and one of them dies, for example. Yeah.
So can you take out a reverse mortgage if you've got another mortgage? yes, but the reverse mortgage must be used to repay the other mortgage. So we're getting that more and more, that people are getting to retirement or to a stage that they want to retire and have a small mortgage left. So reverse mortgage is a great way to repay that remaining balance and have a reverse mortgage, so you don't have the repayment obligations and can actually retire and enjoy your retirement. In terms of the second part of your question around transfer yeah, absolutely. It can you can transfer a reverse mortgage. No, we allow that, provided it's still within our criteria. So if you're looking to downsize, the balance still has to be within our criteria.
And my understanding is you can top them up as well. So if I say want 10% now or $20,000, for example,
Yep.
I can take another 10% or $20,000 at a later point.
Yeah, and a lot of our customers do that. So we call it an express top-up, and people can draw down additional funds, on whenever they choose, really. And we're finding a lot of customers do that because then you're only paying interest on the portion you've drawn. You've got the ability to draw down future amounts, and so that might be for some travel you've got planned in a year's time. Or more and more of our customers are actually using it to assist with things like rates payments and insurance bills, so that kind of one-off costs.
Now, the Auckland District Law Society put out a paper on reverse mortgages in late 2007, so a few years ago now, but I just wanted to read you a quote from it, which was basically their conclusion, and just then ask you whether you agree or disagree with this and why or why not. So they said in their paper, reverse mortgages should be entertained only by those who have carefully explored and eliminated their other options, investigated the specific product under consideration and taken independent legal advice, and perhaps who are over 70 and not looking to borrow more than a small proportion of the value of their home. So do you agree or disagree with that, and what would be your reasons for that?
Well, look, first of all, that is, as you mentioned, I think 2007, so it's quite dated, and we've got to remember that there were a number of poorly developed and poorly sold reverse mortgage type products out there. A number of them weren't reverse mortgages, but they've all kind of been lumped in together. So when Heartland entered this market, being a registered bank, we were very careful that we made sure that our product was socially responsible and that we could stand behind it from a reputation perspective. In terms of what the Law Society is saying there, overall I agree, and a lot of it's kind of hard-coded into our process. We make sure customers get legal advice, and it's independent. That is mandatory for every one of our loans. They should consider all options. Our actual application process, which is available on our website along with our calculators, takes them through different options. It'd probably be the only financial product that I'm aware of that actually says, have you considered, for instance, downsizing? Have you considered borrowing from friends and family? So it actually steps them through and gets them to, have you discussed it with your family, and gets them to actually attest to that. So it's not just any small print. It actually says, have you spoken to your family about this? And then they acknowledge whether they have or not. And if not, they have to tell us why not. So we take through a really thorough process. So in principle, I don't. In principle, I agree with it. Interesting enough that for most of our customers do have a conversation with family where they can, a vast majority, and most of the families are really supportive because they see that the outcomes that are going to be delivered to their parents is what they want. They want their parents to be living in a warm and dry home. They want their parents to kind of do that overseas trip that they've always dreamed about. So most families are actually really supportive.
Well, thanks a lot for that, Andrew. That's Andrew Ford, who's the National Retail Manager at Heartland Bank, and I'm Gareth Vaughan at interest.co.nz.